Picture this. The CEO of the world's most valuable company just landed in Shanghai. Not for a victory lap, not for a product launch, but to salvage what might be the most expensive business relationship in tech history. While you were scrolling last weekend, Jensen Huang, the leather jacket wearing founder of Nvidia, was walking into a party in Shanghai. But this wasn't just any corporate celebration. This was a desperate mission to save access to a market that could generate hundreds of billions of dollars by the end of this decade. Here's what makes this extraordinary. Just 2 weeks before his arrival, Chinese customs agents received a directive that could bankrupt his China strategy overnight. The same week, the United States approved Nvidia to sell its powerful H200 AI chips to China. Beijing told customs officers to ban them at the border. This is the story of how a single semiconductor became the biggest flashpoint in U.S. China relations. How $27,000 chips worth billions in orders are sitting in limbo. And why what happens next will determine who controls the future of artificial intelligence. Stay with me, because by the end of this, you'll understand exactly what's at stake, and more importantly, what this means for your investments, your career, and the technology you'll be using in the next 3 years. Let me set the scene with precision. On Friday, January 23, 2026, Jensen Huang was spotted by Chinese outlet Tencent News at Nvidia's new Shanghai office. He wasn't there for a routine visit. He was there during one of the most critical moments in his company's 33-year history. The timeline matters. Saturday, January 24th, he attended the Nvidia employee party in Shanghai. From there, his itinerary includes Beijing, Shenzhen, and then Taiwan. This is his third trip to China in 2026 alone. But here's what you need to understand. This trip was always on the calendar. It's Nvidia's annual tradition to celebrate with their 4,000 plus Chinese employees ahead of the Lunar New Year. So the timing is routine. What's not routine is the context. Just 10 days before Huang touched down in Shanghai, on January 14th, Reuters broke a story that sent shockwaves through Silicon Valley. Chinese customs authorities had instructed customs agents that Nvidia's H200 chips were not permitted to enter China. Let me repeat that. On January 13th, the U.S. Department of Commerce formally approved Nvidia to sell H200 chips to China with specific conditions. The very next day, China effectively banned them at the border. Here's the exact sequence. January 13, 2026, U.S. approves H200 exports with restrictions. January 14, 2026, Chinese customs agents told chips cannot enter. January 14, 2026, Chinese tech companies summoned to meetings and told not to purchase unless absolutely necessary. January 24, 2026, Huang arrives in Shanghai. According to sources who spoke to Reuters, the wording from Chinese officials was so severe that it is basically a ban for now, though this might change in the future should things evolve. When you see routine corporate events happening during extraordinary circumstances, that's when the real story is unfolding. Huang isn't in China despite the crisis. He's in China because of the crisis. Now let me explain what makes the H200 so important that it's become one of the biggest flashpoints in U.S. China relations, as Reuters described it. The H200 is Nvidia's second most powerful AI chip, sitting just below their Blackwell architecture. It's not their flagship product, but that's precisely what makes it so contentious. Here are the hard numbers you need to know. The H200 delivers roughly 6 times the performance of the H20, which was the China-compliant chip that Beijing de facto blocked in August 2025. That blocking reduced Nvidia's market share in China to effectively zero, according to Huang himself. Chinese technology companies have placed orders for more than 2 million H200 chips. At approximately $27,000 per chip, that's over $54 billion in potential revenue. Nvidia's current inventory? Only 700,000 chips. Demand exceeds supply by nearly 3 to 1. While Chinese companies like Huawei have developed alternatives like the Ascend 910C, the H200 is still considered far more efficient for large-scale training of advanced AI models. But here's the strategic context that changes everything. Washington approved these sales with severe restrictions. No more than 50% of chips sold to U.S. customers can go to China. A 25% tariff on each chip. Third-party audits required. Only pre-approved buyers. Plus, the Trump administration demands a 25% cut of revenue. Let me break down what this means in practice. If Nvidia sells $1 billion worth of H200 chips to China, 250 million goes to tariffs. Only approved Chinese companies can buy. Nvidia can only sell as many to China as they sell domestically. Every transaction gets audited. Now flip to Beijing's perspective. Why would China accept these humiliating terms when they're pushing for semiconductor self-sufficiency by 2027? When you see asymmetric restrictions like this, someone is trying to send a message. The question isn't whether the deal will happen. The question is, what concessions are being negotiated behind closed doors? To understand why Huang is desperately trying to save this relationship, you need to understand what Nvidia has already lost. Let me take you through the timeline of destruction. 2022-2023. U.S. implements initial export controls on advanced AI chips to China. Nvidia responds by creating compliant chips like the H800 and A800 specifically engineered to meet U.S. performance thresholds while still serving Chinese customers. January 2025. Biden administration introduces the AI diffusion rule, establishing global performance thresholds that effectively block flagship GPUs like the H100 and H200 to China. Nvidia engineers the H20 to fall within the allowed green zone. April 2025. Trump administration slams the door completely. Even compliant chips get banned. Nvidia's China business craters. July 2025. Partial reversal. Trump administration says licenses for H20 chips will be approved. But here's the catch. In exchange for a 15% revenue cut to the White House. July 2025. During this same month, Huang visits Beijing and meets with China's commerce minister. This is diplomatic chess at the highest level. August 2025. Beijing retaliates. The Cyberspace Administration instructs all domestic tech firms to stop purchasing Nvidia chips and switch to local suppliers. This is the move that reduced Nvidia's China market share to zero. December 2025. Trump reverses course again, approving H200 sales, but now demanding a 25% cut instead of 15%. January 2026. U.S. formally approves. China blocks at customs the very next day. Here's what this whiplash cost Nvidia. In fiscal 2025, China accounted for 13% of Nvidia's revenue through H2TO sales. That revenue went to near zero after August. Nvidia booked a $1 billion charge for unsold inventory. But wait, there's more context you need to understand. During this same period, Chinese AI company DeepSeek shocked the world by releasing competitive models that reportedly used smuggled or repurposed Nvidia chips in violation of export controls. This triggered congressional investigations and letters to Huang demanding answers. Huang's response? Persistent lobbying. Meeting with Republicans, arguing that export controls don't slow China's AI development. They just hand market share to domestic Chinese chip makers. And here's the evidence he's right. Between August 2025 and January 2026, companies like Huawei, Baidu, and DeepSeek didn't slow down. They accelerated. They learned to squeeze performance out of whatever chips they could access. Market bans don't stop technological progress. They redirect it. Every month Nvidia is locked out of China, Chinese competitors close the capability gap. That's why Huang is willing to fly to Shanghai during a crisis. Time is the enemy. Let me quantify what's actually at risk here, because the numbers are staggering. For Nvidia, China represents potentially hundreds of billions of dollars in AI chip demand by the end of this decade, according to Nvidia's own estimates. Even conservative projections put China's AI chip needs at $50 billion in the next 2 to 3 years. Before the August 2025 ban, China was Nvidia's second largest market. The company has 4,000 plus employees in China and has maintained a presence there for 25 years. Shanghai is a major R&D hub. But here's the strategic calculation Huang faces. If Chinese companies master AI without Nvidia's chips, Nvidia loses more than current revenue. They lose future platform dominance. Every researcher, every developer, every AI engineer who learns on Chinese hardware instead of Nvidia hardware is a lost customer for life. As Chinese analyst Lu Xiang noted, Huang may be deeply concerned that Nvidia's advanced chips could become not so advanced in the Chinese market in just 2 to 3 years' time. For Chinese tech companies, companies like Alibaba, ByteDance, Baidu, and Tencent have placed orders worth billions. They are not doing this casually. The H200 dramatically accelerates training for large language models, image generation, and autonomous systems. While Huawei's Ascend 910C exists, multiple sources confirm it still lags the H200 for large-scale training. The gap is narrowing, but is not closed. For the U.S. government, the calculus here is complex. On one hand, security hawks argue that any chip sales to China accelerate their military and surveillance capabilities. On the other hand, completely blocking sales just forces China to become self-sufficient faster. The Trump administration's approach tries to thread this needle, allow sales under strict conditions, extract tariff revenue, maintain auditing rights, and slow China's progress without completely cutting them off. But here's the risk. This strategy assumes China needs these chips badly enough to accept humiliating terms. What if they don't? For Beijing, China's strategic goal is clear: semiconductor self-sufficiency. Every dollar spent on Nvidia chips is a dollar that doesn't go to domestic chip makers. Every AI model trained on H200s is a model dependent on American technology. China's leverage comes from being able to say no thanks to conditional sales. But the cost of that stance is measurable. Slower AI development in the short term, which matters when you're racing against the United States for AI supremacy. The directive to customs agents and the meetings with tech companies suggest Beijing is using access as a negotiation tool. The question is, what do they want in return? According to the information, Beijing may grant exemptions for university research partnerships and R&D projects. This would allow Chinese institutions to access H200s while steering commercial purchasing to domestic alternatives. Actionable takeaway number 4. In geopolitical negotiations, the side that needs the deal least wins. Right now, both sides are pretending they don't need this deal. That's when you know something major is being negotiated behind the scenes. While Nvidia and Washington debate export policy, let me show you who's actually winning. Huawei. Their Ascend 910C chip is rapidly improving. While it still trails the H200, the gap is closing. More importantly, Chinese companies are optimizing their AI models specifically for Ascend chips because they know they're the only guaranteed long-term option. Chinese AI companies. Between August 2025 and January 2026, while Nvidia chips were banned, Chinese AI firms didn't sit idle. They developed more efficient training methods, created models that perform better with less computational power, built infrastructure around available hardware. DeepSeek's release of competitive models using older or smuggled chips proved that China's AI capability isn't purely hardware dependent. Baidu. They're consolidating China's GPU cloud services around domestic chips. As Tom's Hardware reported, China's GPU cloud is increasingly built on Baidu and Huawei infrastructure, not Nvidia. AMD and Intel. While Nvidia fights for H200 access, AMD is quietly positioning its MI325X chips. Intel is also in the mix. Both companies are watching Nvidia's China struggles as potential opportunities. Here's the competitive reality that should terrify Nvidia. Every quarter they're locked out of China, the competitive landscape shifts. Chinese researchers publish papers on training methods optimized for non-Nvidia hardware. Chinese companies build tools and frameworks around alternatives. The ecosystem evolves without them. As Forrester analyst Alvin Nguyen put it, this is older AI technology. It is still useful, but adding a premium to it when the Chinese AI ecosystem is catching up or caught up to what is being offered will make it a target for capacity rather than a first choice for enterprises in China. Translation: even if China allows H200 imports, by the time they arrive, Chinese alternatives might be good enough that companies only buy H200s as backup capacity, not primary infrastructure. Actionable takeaway number 5. In technology markets, being locked out for 6 to 12 months can be fatal. Not because your product becomes obsolete, but because the ecosystem learns to work without you. That's the real fear driving Huang's urgency. Let me walk you through the realistic scenarios and what each means. Breakthrough during Huang's trip. Huang meets with government officials. China agrees to limited H200 imports for specific use cases like university research and approved commercial customers. Nvidia gets access, but on Beijing's terms, not Washington's. Probability: medium. Implications: Nvidia gets some revenue, but not the market dominance they want. Chinese companies get temporary access while building domestic alternatives. US loses some leverage. Continued stalemate. Customs block remains in place. Huang's trip is purely symbolic, maintaining relationships while waiting for higher level negotiations between Washington and Beijing. Probability: high. Implications: Nvidia continues losing market share. Chinese alternatives accelerate. By mid 2026, the window for Nvidia's China business may close permanently. Grand bargain. The H200 issue gets bundled into broader U.S. China trade negotiations. Access gets granted as part of a larger deal involving tariffs, technology transfer, or other strategic interests. Probability: low to medium. Implications: everyone saves face. Nvidia gets market access. China gets concessions elsewhere. Both sides claim victory. Complete breakdown. China decides full semiconductor self-sufficiency is worth the short-term pain. H200 chips stay banned. Nvidia's China business becomes permanently zero. Probability: low but increasing. Implications: catastrophic for Nvidia's long-term Asia strategy. Accelerates Chinese chip development. Creates completely bifurcated global tech ecosystem. Here's what to watch as signals. Positive signals: announcements of approved H200 purchases by major Chinese tech firms. Huang meeting with senior Chinese officials in Beijing. Softening of customs restrictions. Language: Chinese companies resuming Nvidia chip orders. Negative signals: Huang leaving China without announced agreements. More Chinese companies announcing all domestic AI infrastructure. Chinese authorities formalizing H200 ban in official policy. Huawei announcing major Ascend chip improvements. The reality is that Huang's trip happens during a critical 30 to 60-day window. If access isn't restored by March 2026, Chinese companies will have committed to alternative architectures for their next-generation infrastructure. At that point, even if H200 access opens up, the market opportunity will have permanently shrunk. Watch for announcements in the next 30 days. The real news won't be Huang's trip. It will be whether any major Chinese tech company announces an H200 purchase order. That's when you'll know if this mission succeeded. Let me bring this home with 3 reasons why you should care about what's happening in Shanghai this weekend. First, investment implications. Nvidia stock fell over 1% when Reuters reported the customs block. That might seem small, but understand what it signals. The market is pricing in permanent loss of China revenue. If you hold Nvidia stock or any fund with significant Nvidia exposure, the resolution of this situation will move valuations by tens of billions of dollars. Moreover, watch Chinese chip makers like SMIC and Huawei suppliers. If this ban holds, they're the beneficiaries. Second, technology trajectory. The AI tools you'll use in 2027 are being determined right now. If Nvidia loses China, global AI development bifurcates into Western and Eastern ecosystems with different capabilities, different interfaces, and different compatibility. This matters for developers, for businesses planning AI integration, for anyone whose career involves technology. Third, Geopolitical precedent. What we're watching is how U.S. China technology competition will work for the next decade. If conditional sales with tariffs and revenue sharing becomes the model, expect this framework to extend to quantum computing, biotechnology, and other frontier fields. The question of whether nations can trade advanced technology while competing strategically is being answered in real time. So, yes, this story is about a CEO attending a party in Shanghai, but it's really about whether the world's most important bilateral relationship can manage technological competition without complete decoupling. The outcome matters for your investments, your career, and the technology landscape you'll navigate for the next decade. Huang will leave China by the end of this week. Watch what gets announced in the following 30 days. That's when we'll know if this high stakes gamble paid off, or if we just witnessed the beginning of the end for Nvidia's China business. The $3 trillion company's future in the world's second largest economy hangs in the balance, and the CEO knows it. That's why he's in Shanghai,